All right, let's jump right into this explainer and unpack the massive, frankly existential impact the Digital Personal Data Protection Act is about to drop on the Indian banking sector. For decades, banks have essentially operated as these giant data consumers, scooping up and using personal information with pretty loose boundaries. Historically, customer data was just looked at as a marketing asset, right? Something you mine for cross-selling without losing much sleep over liability. Well, that era is absolutely over. We are looking at a fundamental rewiring of how every single bank employee interacts with customer data. We're moving from a world of casual access straight into one of intense, heavily regulated scrutiny.
To really put this into perspective, let's talk about the sheer scale of this new reality. We're looking at a potential penalty of 250 million, actually scratch that, it's 250 crore rupees, and that's just for a single data privacy slip-up. We are definitely not talking about a regulatory slap on the wrist here. This is a balance sheet altering fine that can literally derail an entire financial quarter. And what makes it even worse? These fines have to be explicitly disclosed in your annual report. So on top of the direct financial hit, you're bringing on massive reputational damage and immense shareholder scrutiny.
So let's kick things off with Section 1, the 250 crore banking risk.
We really have to internalize that this incredible financial risk isn't just an IT problem anymore. It's not just about stopping some hacker on a dark hoodie from breaking into a mainframe. Simply failing to take reasonable security safeguards to prevent a personal data breach carries that maximum 250 crore penalty. And if a breach does happen and you fail to notify the board in time, bam, that's another 200 crores. The compliance burden has shifted dramatically. It's moved out of the heavily fortified server room and landed squarely on the bank teller's desk. Every single employee is now a potential liability point.
Moving right along to Section 2, from ITIA to DPDPA.
If we look back at the evolution of our privacy laws, we started with the Information Technology Act of 2000, which basically just gave legal recognition to electronic documents. Then, in 2008, Section 43A was added to cover reasonable security practices for sensitive data, kind of like a basic set of guardrails. But the game changes entirely in May 2027. This isn't some slow, gentle transition with training wheels. It is a cliff edge. On that exact date, Section 43A is officially gone, and the stringent DPDPA rules take over completely. Organizations that aren't operationally ready on day one are walking straight into a regulatory buzzsaw.
So the crucial takeaway here is that banks are no longer just passive consumers of data. Because of the incredible volume and the highly sensitive nature of the financial information they handle, banks are officially leveled up to significant data fiduciaries. And no, that isn't just a fancy regulatory title. It comes with immense, completely non-negotiable legal obligations. As a significant fiduciary, banks carry way more burden than regular businesses. We're talking mandatory data protection officers based right here in India, independent data audits, and rigorous data protection impact assessments for every single new product or service. Which brings us to Section 3, everyday data privacy nightmares.
To truly grasp this, we need to zoom into the daily life of a local bank branch, because this is where these abstract laws become absolute operational minefields. The branch level is where these regulations will be stress-tested every single day. Picture this scenario. A third party walks in with a high-value check drawn by one of your customers. The branch manager, trying to do the right thing and prevent fraud, calls the customer to verify it. But the customer's spouse answers the phone. The manager, without really thinking, accidentally blurts out the details of the check and who is cashing it. Suddenly, this inadvertently sparks a massive family dispute, or in a worst-case scenario, maybe even a divorce.
Under this new law, what happens next is going to be a severe culture shock for the banking industry. The customer files a complaint with the Data Protection Board for a massive privacy breach. That totally simple lack of due diligence, just failing to verify identity before speaking, constitutes a major violation. What used to be considered, good, helpful customer service, being friendly on the phone with a family member, is now literally a federal breach. It just goes to show that even routine verifications are highly dangerous now without strict, unyielding privacy protocols.
We also need to clear up a huge misconception when it comes to compliance. A generic privacy policy tucked away in the footer of your website? Yeah, that's not going to cut it anymore. A policy is really just a general declaration of intent. The DPDPA requires a specific, highly granular privacy notice every single time you collect data. Just think about the operational headache this causes. We're talking highly specific UI pop-ups on apps, custom physical forms, or distinct digital checkboxes designed for every unique interaction. You have to state exactly what data you want, exactly why you need it, and exactly how the customer can instantly exercise their rights to access or erase it.
Here's another scenario, a real nightmare when it comes to data rights and nomination. It's a heartbreaking situation, but it puts the bank in a massive legal bind. Let's say a general manager passes away, and his daughter demands access to his official bank email and passwords because, unfortunately, he used his corporate email for personal family finances and investments. She desperately needs that data to settle his estate. So what do? Does the bank just hand over the keys out of compassion?
The legal reality is incredibly strict here. It sounds cold, but the bank's action plan must be to politely but firmly refuse. That email is a corporate asset governed by IT policy, not inheritance law. Handing over the password would instantly breach the privacy of countless other customers and employees whose data is just sitting in that inbox. You can only retrieve and segregate personal data if it's properly verified and ideally court-ordered. And think about how hard that is technologically. Segregating personal data from corporate data in a massive inbox is a giant IT undertaking. This is exactly why branches need standard operating procedures ironed out way before these tragic situations happen.
All right, on to Section 4, when RBI meets DPDPA.
The Reserve Bank of India is definitely not just sitting on the sidelines waiting for the DPDPA to roll out. They're actively turning up the heat and aligning their own guidelines with this new privacy reality. The RBI's May 2026 guidelines effectively kill off that bundled pre-ticked consent box we're all so used to ignoring. Now, institutions need granular, unbundled consent for every single product. And here's the kicker. Digital interfaces must strictly default to no. This literally means every banking app UI in India has to be completely redesigned from the ground up to ensure active user opt-in. Plus, banks must keep time-stamped, undeniable audit trails of these consents for at least a full year after a contract ends. Furthermore, the RBI has explicitly banned manipulative digital interfaces. You know those tricky little UI elements? They're called dark patterns. This means no more basket sneaking, where insurance magically gets added to a user's cart right before checkout. And there's a strict ban on confirm shaming. You've definitely seen this one. It's when a UI guilt trips you into clicking a button that says something awful like, "No thanks, I prefer my family to be financially ruined," just to decline life insurance. Product managers and UX designers are now directly legally liable for making sure these tricks are completely eradicated.
And here is a massive game changer. If a bank forces a customer to buy an auxiliary product, like, say, life insurance, just to get approved for a core product like a home loan, that compulsory bundling is completely banned. Look, we all know how deeply ingrained this conditional selling culture is within branch staff habits. It's been a cross-selling staple for years. But breaking that habit is going to be one of the hardest parts of DPDPA compliance, because if mis-selling is proven now, banks are legally mandated to execute full refund clawbacks of the entire amount paid, plus compensate the customer for any loss. The days of conditional selling are absolutely, decisively over.
Finally, let's wrap up with Section 5, the branch-level solution. So, as we've seen, the operational risks are sky-high. The RBI is watching your every UI move, and the penalties are severe enough to bankrupt smaller institutions. How on earth does a bank actually survive this? We have to zoom out and completely rethink our centralized compliance strategies. The reality is, a single head office data protection officer can't possibly police every customer interaction across thousands of local branches. It's impossible. The paradigm shift we need is recognizing every single branch as an autonomous micro-compliance unit. The branch is where the data is actually collected, making the branch the real data fiduciary. This forces a massive identity shift for the branch manager, who now has to act as the designated sub-DPO.
This brings us to a highly specific solution, the DGPSI Bank Branch Framework, or the Data Governance and Protection Standard of India. This framework brilliantly decentralizes compliance. It acknowledges that for the data principal, the everyday customer, the local branch is where their privacy rights actually need protecting. This layered architecture ensures that compliance isn't just a thick theoretical binder collecting dust in a head office. It becomes a tangible, day-to-day operational reality at the branch level, empowering staff to protect data locally.
For the branch managers out there stepping into this intense new sub-DPO role, the roadmap is clear, but it is demanding. First, you have to inventory and carefully classify all the personal data flowing through your specific departments. You have to enforce those strict privacy notices and secure clean, unbundled consent. You also have to actively manage customer rights,
If someone walks in and demands, "Delete my data," you need a system to execute that erasure instantly, without accidentally breaking core banking functions or deleting compliance records that legally must be kept. And most importantly, you are the critical first line of defense for immediate breach reporting.
As we wrap up this explainer, you really have to ask yourself and your organization a tough question. When that May 2027 deadline hits and the DPDPA is fully weaponized, will your local branch be the weak link that triggers a catastrophic 250 crore rupee penalty? Or have you done the work? Have you trained your teams, decentralized your compliance architecture, and built a true fortress of data privacy? The clock is absolutely ticking, and the time to rewrite your operational playbook is right now.